Okay, I might as well start the webinar on this very topical topic about this 30% tax on super balances over $3 million. As I mentioned, my name's Mark Forte. I'm a senior principal here at Wilson Pateras, specialising in the business services area. With me today is Nilay Shah, who is our superannuation guru, who is, unfortunately for him, is a Hawthorn supporter, but then again, I'm a Carlton supporter still bleeding from last night. So not great from the football sense, but for Nilay, he's got 10 years of experience being with Wilson Pateras for a long time. And he is very excellent at what he does. So I think what we might do, we might start this webinar now. So Nilay, you've got the slides. So I might go to the first slide.
Sure. Thanks, Mark.
Okay,
hello, everyone. And let's start in.
Okay, so that's our general advice warning. This is purely just general in nature in terms of what we're discussing today. So don't take it as being formal advice. It's just more of an information session about the $3 million cap, or the tax on the $3 million in excess of all that. Here's the table of contents that we do have, what we'll be discussing today. So go to the next slide, Nilay. We'll see what the table of contents are. So we're talking about the summary of the super changes, which is a bit of a history. Brief explanation about the TBC, which is a transfer balance cap, and the total superannuation balance. There's always tends to be confusion in relation to those definitions. Nilay will then go into the crux of the webinar today about the proposed tax on the $3 million with some worked examples and how that's all calculated. And then we'll look at in terms of what the concerns and challenges arising from this proposed policy from the Labor government, matters that should be considered as we move closer to any, impending start date, if that is to happen, what to do next, and another discussion on the transfer balance cap. But just before Nilay does get into it, I thought it was interesting to look at the stats of self-managed super funds in Australia, and all this is sourced from the ATO. So in June 2022, there was 603,432 self-managed super funds in existence, of which there was 1.123 million members of those funds. Out of those funds, 69% had 2 members, 24% had 1 member, and 7% had 3 to 4 members. Of those 603,000 funds, it had a total in assets of $868 billion in assets, whereas in the total superannuation industry, there's $3.3 trillion worth of superannuation assets. In June 2021, the average balance per member was $790,808, where the average age of those funds per member is 62 years old. In June 2021, percentage of self-managed super fund balances that had in excess of $2 million was 20.1%. So that's what it gives you, a brief background in terms of stats. It's always interesting to know, just to see how the superannuation industry is going, particularly with self-managed super funds. What you see on screen is a summary of super changes. There's been a lot of super changes. I'll just try to pick out the eyes of, the most important ones in recent times. But to really start, even before that 1992, it's interesting to know that the age pension started in 1909. Where the age pension per year was £26 per year, which is quite extraordinary given, the rate of inflation since then to today. In 1915, earnings on superannuation investments became tax-free by legislation, and there was legislation put in place to make deductible employer contributions. In 1974, there was 32% of the workforce was covered by superannuation, and that increased up to 1990 or 64%. In 1983, the Hawke Labor government expressed support for employee super contribution, where they joined with the ACTU in 1986 in seeking a 3% contribution to industry funds. So as you can see on the timeline, the super guarantee was introduced in 1992, where the mandatory rate payable by employers was 3%. That will now increase to 12%, and that commencement date to that will be 1 July 2025. So that currently is 10.5% for this year, but will increase to 12% up to 1 July 2025. In 2007, major superannuation changes were made, where basically I'll sort of summarise some of those there. But to summarise those is that money taken out of super, if you was over 60 years old, became tax-free. So basically you don't declare any money taken out of super on your tax return. What we know today is pensions, being account-based pensions, were introduced. Contribution caps were also introduced, and that's basically your concessional caps, which is up to $27,500, of which the employer or yourself can claim a tax deduction for. And there's your non-concessional caps as well, which is $110,000 per year that you can claim, subject to strict criteria. And the final major point that came in 2007 was in relation to SMSF. They could actually borrow money to buy a property. Back in those days, it was called an installment warrant relationship. So we fast-tracked 10 years, and in 2017, there was major changes where the Liberal government introduced a $1.6 million cap on a pension, which began in 1 July 2017. They introduced this concept of transfer balance caps and superannuation balance caps, of which Nilay will explain in greater detail in pretty much in the next slide, and transition to retirement income streams. Previously, they were tax-free for people who didn't quite meet retirement age and were still working, and they could still take money out of super by paying pensions, I think up to 10% of their superannuation balance. That was tax-free. In 2017, that converted to any money that you take out will be taxable under a transition to retirement income stream. In 2018, the downsizer contributions were allowed. Basically, that means if you sold a home or a property that was your home for any period of time, and you're at the age of 65, which is now reduced to 55, then you could able to put in $300,000 into your superannuation tax-free. In 2021, previously self-managed super funds had 4 members as the maximum balance of, as the maximum amount of members they could have. That is now increased to 6 members. And then we're looking at 2026 at this proposed policy, or this policy that the Labor government has put through. The commencement date will be 1 July 2025 if it does get through, to tax additional, to tax additional 15% on superannuation balances. So all that shows is that there's always been constant change with superannuation. With constant change comes to a cost to trustees, which basically from a administrative point of view, it's updating your trust deeds, because that's very critical to stay compliant with the superannuation legislation. So I suppose just after that summary, I think what I'll do now, I will introduce Nilay Shah, as I mentioned, who heads our superannuation division. So Nilay, over to you.
Thanks, Mark. Thanks for taking everyone through this summary of super changes, which is quite an extraordinary, isn't it? Over the years, the system has changed significantly, and we are yet to hear more changes. So with these slides, as Mark mentioned before, we are trying to understand the difference between the general, like a transfer balance cap, and the superannuation balance cap. So what is the difference is they're completely different matter. And we need to understand what is the importance and the meaning of each, so that more informed decisions can be taken. So the transfer balance cap is a limit of the funds you can keep in your pension account. So whether a person can have 3 million, 4 million, 5 million, 10 million, 15 million, whatever that amount would be, but only only an amount up to the total, the transfer balance cap you can keep into your pension account. Now, this cap has changed over the years as well. Initially, it started with 1.6, then 1.7 now, and from 1st of July 2023, which is now, it's going to turn into 1.9 million. When we will look into that in detail, which is later in this webinar. And the second matter, which is a total superannuation balance. Now, this is relatively easier to understand that term, is because what it made of it's all the superannuation accounts balances in a summary. So if a person would have accumulation account balance, multiple pension or single pension accounts, and some of them, it's a remitted recourse borrowing arrangement interest as well, and less a structured settlements. Now, The last two bits, which is the limited recourse borrowing arrangement and the structured settlements, they are not that obvious matters. So mainly the superannuation fund, the TSB, which is we call total superannuation balance, is made of mainly two things: is the accumulation account and the pension accounts, the total of all. And that's the important terminology, because this measure we are about to discuss about, it's made of on that matter, which is total superannuation balance. So once that is kind of clear, let's go on to the original topic. Let's try and understand these new measures which was declared, and let's try to analyze it. So this one is the overview. So what it's proposed through the Treasury, I think it was on 1st of March 2023, then it was proposed, and since then we are working on it. So first is the individual bill balance is over 3 million at the end of the financial year. They would be subject to additional 15% tax on the earnings on any balance that exceeds 3 million threshold. So what they're saying is, at the end of the financial year, if your member account balance is more than 3 million, which is again the total superannuation balance, which is accumulation account and pension account, then you are affected with these changes. The second overview item is this measure will commence on 1st of July 2025 and apply for the 2025-2026 financial year onwards, which means it's not happening. Anything is happening now. Nothing is happening at the moment. So we have more than 2 years before this measure will be implemented. And if it will be implemented, that's another thing to look into it as well. The third point is the 3 million threshold is based on your total superannuation balance, and it includes all of your superannuation accounts, which we just discussed. It's just a repetition, but just to an understanding of, it's mainly in deals with total superannuation balance. The fourth point, the 3 million threshold is not indexed, which means the 3 million threshold will remain the same from if this measure to become a law. From 2026, this threshold will not be indexed for going period of future time. Like, so in 10 years down the track as well, the 3 million will remain there. And we will discuss more about that matter. The implications and the effect of that indexation would be significant, and we will discuss that in a later slides as well. The next one is 15% additional tax on earnings will be paid by the individuals and not by the superannuation fund. And the individuals will have a choice of either paying that tax themselves or from the super fund. They can choose to elect whichever account they want to choose from. So in that particular matter, so how it works is the self-managed super fund works the same way as it's working now, right? And it will pay the tax as it's paying it now as well. What they're proposing it, on top of that, the individuals will be paying tax on the individual level. So nothing to do with the super fund. So super fund will be working as it is working now. On top of that, on the individual level, ATO will calculate how much is a tax liability on the basis of this measure, and ATO will give an assessment that on a basis of these rules, this is a liability that it's upon you. You can choose to pay out of your personal funds, which is outside super fund, or you can pay it out of your super fund accounts as well. And then you can inform the ATO that I wish to withdraw funds from my super fund accounts, and it works upon that way. So it's quite similar, the measure, like the arrangement as we have with the Division 293 tax at the moment. If some of you people would aware of that Division 293 tax, that's how it works is if you're earning, and they have a specific methodology of evaluating that earning, but if you're earning under your personal level, it's more than $250,000, then when you lodge your individual personal tax return, ATO would come to know that you're earning more than $250,000, and then they will issue an assessment to you on a basis of your concessional contributions made in superfund. So similar thing, the similar process, they are offering here as well. And then the last one is the ATO will use a 3-step formula to calculate the proportion of the total earnings which is subject to additional tax. So as I mentioned before, once the self-funded super fund tax return will be lodged, ATO will have all the information they required in order to work out the possible or probable tax liability. And then they will issue an assessment on that basis. So let's work it out. What is this formula? What is this 3-step formula, so that you have a more understanding of how it works? Into the next slide. So the first step is to work it out, the earnings. Now, what the earnings, what they're saying is the TSB, which is your total super balance, current financial year, less total super balance, previous financial years, and plus withdrawals and net contribution. So what they're saying is, in hypothetical, I'll just give you an example. So if a member has 3.5 million as of 30th of June 2025, okay, and that 3.5 million is a total of accumulation account and pension account. So in the super fund, when you have a financials, when you have a look of your member statement, you can easily see your member account balance, which is made of pension and accumulation account, sometimes only accumulation account, sometimes only pension account. But whatever that might be, the total of both components will be the balance as of 30th of June. So what we are comparing here, the total superannuation account balance as of 30th of June 2025 was 3.5. And as of 30th of June 2026, it will be, for example, 4 million. So what they're saying is plus the withdrawals. So which means if you would be in a pension, or if you are about the age where you have withdrawn some funds out of the super fund, what they're saying is they will add back into that calculation, and they will remove any contributions were made. So in effect, what they're saying is whatever the member account balance is, the difference is they want to reduce the effects of the contributions and the withdrawals because they're adding back both. So by that way, they want to focus on only majorly 3 things. One is the actual income, which includes realized gains as well. The second thing is the expenses, the actual expenses. And then the third thing, which is the unrealized gains, which is the market valuation movements, which is increased or decreased from last year. So mainly those 3 things made of these earnings. Okay, so that's the second step. Let's have a look at the second step. The proportion of the earnings corresponding to the funds above 3 million. So for example, what they're saying is, and the formula is TSB of the current financial year, in that example, 4 million, current financial year, 30th of June 2026, less 3 million, which is 1 million, divided by TSB current financial year, which is 4 million. So in that particular case, 1 million divided by 4 million. So 25% is a proportion of the earnings in that example. And then the third one, which is to calculate the tax liability. And what they're saying is 15%, which is the additional tax. So that 15% multiplied by the earnings, which we find out in earnings step 1, and multiply with proportion of the earnings, which we calculated on step 2. So this is kind of procedure, like this is kind of formula that ATO would use to work it out what's the tax liability, if any. So let's try and have a look of some examples so that we'll have a more understanding of how it works. Okay, so this example. Now over here, the example is based on balance not affected by the changes. So Debbie has a balance of, in her superannuation fund, of 150,000 as of 30th of June 2025. Debbie's balance as of 30th of June 2026 is $165,000, which is increased, but still under 3 million. So the proposed changes will not apply to Debbie because her total superannuation balance is less than 3 million, which is quite simple. I think everyone understands that. As long as your member account balance is less than 3 million, this measure will not be applicable to that person. The second example, Warren. Warren is 52 with 4 million in the superannuation as of 30th of June 2025. He makes no contributions or withdrawals. Let's keep it simple. By 30th of June 2026, his member account balance has grown to 4.5 mil, which means his earnings would be 4.5 less 4, because you're comparing 30th of June 2026 balance compared with 30th of June 2025, which is $500,000 difference. Because there is no withdrawal or contributions, there will not be any changes with the earnings calculation. Now let's calculate the proportion of the earnings. So the proportion of the earnings will be calculated by 4.5, which is 30th of June 2026 balance, less 3 million, which is a threshold, divided by 4.5 million, which is the 30th of June balance, 30th of June 2026 balance. So that calculation comes to 33.33%. And now on the basis of that, we can calculate the tax liability, 15%, which is an additional tax, 500,000, which is the earnings, and 33.33%, which is the proportion of the earnings, which comes to $25,000 tax. Let's have a look at one more. Now, Carlos, he is 69 and retired, and seems quite fit. Just happy. His SMSF has a superannuation fund balance of 9 million on 30th of June 2025, which grows to 10 million on 30th of June 2026. He draws down 150,000 during the year and makes no additional contributions to the fund. This means Carlos's calculated earnings are 10 million, current year's balance, less previous year's balance 9 million, plus 150,000 of the withdrawal, because we are adding back the withdrawals, comes to 1.15 million. Let's check it out, his proportion of the earnings then. 10 million, which is a current balance, less 3 million divided by 10 million, which is 70%. And on the basis of that, the tax liability will be 15% tax on 1.15 million, multiplied by 70% proportion of the earnings, which comes to 120,750.
Yeah,
Now,
sorry, just to interject on that. So that's basically the tax on the excess over, with the new tax, the excess over $3 million. But any other additional earnings that the funds earned during the year, being interest, dividends, rent, whatever the case may be, that's also taxed at 15%, regardless of what your fund balance is as well.
That's correct. That's 100% correct. Yes.
That's only one component of the tax, only one for the whole year.
That's right. That's right. So all the realized income, which is actual income, interest, dividends, distributions, all, and realized gains, capital gains, all of the realized income, all the realized expenses, which reduces that, and the third component, which is the unrealized ones. Yes. So yes, you're right. So that income component will be considered in earnings calculation. Yes.
Okay. Probably just another question. I'm not sure whether this is really covered by the fact sheet released by the government. What happens in the case, say you're $3.6 million one year, but due to investments that have gone bad, your balance comes down to $2.8 million. What happens in that situation?
It's a good question. So what happens is, because now it's gone down in the valuation, then instead that earnings will be negative. And when that earnings will be negative, there is no tax payable for that particular year. But you don't get to any refund because of your earnings is negative, but that will be carried forward. It's like a tax losses. It will be carried forward negative earnings in the future financial years until you have a positive earnings, which will offset that carried forward kind of earnings in loss kind of thing, to reduce that earnings in that financial year, if that makes sense.
It makes sense. Is there any time limit in terms of how long that earnings can be carried forward, or that loss can be carried forward? Is it indefinite, or is a timeline to it?
There is no timeline prescribed in this measure, which means, it's my understanding, is it's indefinite, which means if that negative earning will be utilized in 10 years down the track, so be it, that's fine.
Okay, no problems. I'll just note to the viewers, if you have any questions, there is a webinar chat or a Q&A. So if you've got any questions, please put it into the box and I'll make sure that I will ask Nilay those questions.
Thanks, Mark. So that's about it. Let's have a look of it. A couple of more examples. So example is election to pay liability from the funds and the concession contributions during the year. Now, Louis is 40, working 30th of June 2026, she has a member account balance 2 million in APRA regulated fund and a balance of 3 million in self-managed super fund. So she has two different accounts. One is an APRA regulated retail or industry fund, and one is a self-managed super fund. As 30th of June 2025, the APRA fund has 1.9 and the SMSF has 2.9. She does not meet any condition of release because, of course, she is 40, so she's very far from meeting any condition of release, and nor she has any withdrawals during the year because, of course, she didn't make any condition of release. There are some special cases, but this is not applicable to her here. She makes $20,000 worth of concessional contributions, and her contributions net of tax contributions is 17,000. This means Louis' calculated earnings are 5 million, which is total of both superannuation fund balances, less 4.8 million, less 17,000, which is a net of the, so the 183,000 comes back to the earnings calculation. Her proportion of the earnings would be 5 million, less 3 million, which is the threshold, divided by 5 million, which is the current balance. So 40%. This means her tax liabilities comes to 15% tax, 183,000 is the earnings multiplied by 40% of the proportion. So 10,980. Now, Louis elects to pay 5,000 from her retail fund and 5,900 from her self-managed super fund. That's possible. That's fine, because when you get an assessment from the ATO, at that time, ATO can see that you have multiple superannuation fund balances, and you can pick and choose how much you want to pay from one fund, another fund, or you can pay out of your personal funds as well. So that this example is just to illustrate that there are multiple ways you can pay off that tax liability. And this one is the one you were talking about, Mark, which is the carried forward of earning losses. So let's try and understand through this example. So Dave is 70, has 2 APRA regulated funds and 1 self-managed super fund. As of 30th of June 2025, the TSB across all funds was 7 million. During 2026, he withdrew 400,000 from SMSF and makes no contributions. As of 30th of June 2026, that's 6 million. So that's reduced by 1 million. This means the earnings would be 6 million as of 30th of June 2026, less 7 million, 30th of June 2025, plus 40,000, because to add back the withdrawal. So 400,000 comes to negative $600,000 of the earnings. His proportion of the earnings, which is 6 million minus 3 million divided by 3 million, which is 50%. The earnings loss attributable to the excess balance of 300,000. Dave can carry forward 300,000 to offset the future excess balance earnings. As of 30th of June 2027, the Dave's fund makes earnings on his excess superannuation from 650,000. He carries the carried forward loss of 300,000 and only has to pay the remaining amount of the earnings, which is 350,000 at that time. This means his tax liability for 2026 will be 0, but 30th of June 2027 would be 15%, which is a tax, 350,000, which is the net earnings after utilizing the carried forward negative earnings from 2026 financial year, which would be $52,000. So that's what it comes down to. In this particular case, you can understand that loss attributable to only 300,000, not the 600,000, because the proportion of the earnings would need to be considered as well. So those are the examples to understand different situations and different circumstances and how would this measure will be affecting. Now let's look into what are the concerns or the challenges with these measures, like and let's try to understand what are the implications of those things. So first of all, no indexation. No indexation, which means, as previously discussed, that $3 million threshold is not indexed, which means it will remain there forever kind of thing. So And I've got some stats just to get you an understanding that in 40 years, from 1982 to 2022, the wages have increased 5.3 times. The Sydney house price were increased by 4.6 times, and Australian Stock Exchange by 15.7 times. So what they're saying is clearly many young people with normal working years before retirement, because higher than average salaries and super fund experiences, will be caught by this measure. So in, I don't know, but 15, 20 years down the track, maybe 60, 70% would be affected by these measures. So, which if you think it's a significant amount of tax for various people. The second concern or challenge is earnings includes the unrealized capital gains. And that's what we discussed already, that the mainly three components of the earnings would be the realized income, which is all forms of income, which you actually realized. You received the money in your bank account, whether it's interest, dividend, distributions, rental, whatever that might be. The second component is realized expenses, which is the expenses incurred in order to earn those income. And then the third component, which is we are talking about here, is that unrealized capital gains, which is the movement in the market valuation. So this is one of the matter which is quite picked up by in the media and different organizations, because it seems to be not realistic. We are not here to judge, but we are just talking about what are the concerns and the challenges with that particular matter is imposed upon.
Yeah, maybe on that point there, Nilay, I mean, a lot of super funds that we have within our client base, they have a lot of property in there as well. And they have a lot of investments in what they call unlisted unit trusts. So it might be a unit trust which a super fund owns 100% of the units in that unit trust, and that unit trust owns property. So what the challenge is going to be, and I know you'll allude to it in the next slide as well, but in terms of getting realistic valuations for those properties. Currently, the superannuation law, I believe, allows valuations every 3 years. But with this particular type of change in policy and potential legislation, is that the $3 million cap is going to be, I suppose, closely scrutinised by the ATO each and every year. So it may require to do valuations which are not just normal curbside valuations, probably more defined valuations, being the ATO guidance on that. What I mean by that is that there's valuations that real estate agents can do, but they have to have property sales in the area, past history, a whole range of, I suppose, information to support what their valuation is going to be, which may actually have to cost a bit of money to get proper valuations done as well. So one of the challenges is how getting proper valuations possibly each and every year to justify whether you meet that $3 million, I suppose, threshold or not.
That's quite right, Mark, because if this measure becomes a law, for example, any evaluation movement, and mostly upside, gets you to pay tax, which means that trustees will have to be very careful with the correct valuation is reported as well. And that's why there are some people are speculating that the valuation companies or the valuers' value will be significantly higher if these measures to come into the picture. So, but you're right, the valuation will be really important because that will determine the proportion of the earnings, and that's quite right what you just mentioned there. It's important to have valuations more regularly and from the right sources. Yes. The third point we are talking here is the defined benefit balance. Like some of those members would have old, but and some of the legacies ones, but the defined benefit balances. Now, the complexities of defined benefit funds, it's not addressed in this measure whatsoever. So we don't know what that would be. So if any one of the members would have defined benefit balances, we don't know how they will be treated, how earnings or how the TSBs will be calculated for those defined benefit balances. That's something to look into it when more information or more detailed things will be coming into the picture. The next one is the cash flow. And that's one of the most important things to consider, because some of those times this tax liability will be imposed, and then it has to be paid either from the personal funds or from the superannuation funds. Sometimes it's possible that in both the avenues you won't have the liquidity, or members won't have the liquidity, because from some instance the people are retired, which means they don't have any regular source of employment or the business income because they are retired, except the passive income they would have. So they would have liquidity issues outside super fund and inside if they have a significant bulky assets, for example, a property, which would have lesser amount of returns, which means that amount of income would barely sufficient for managing their self-managed super fund plus the pension withdrawals. In those sort of situations, planning for the cash flow and the liquidity is quite important. So some of those things must be considered if these measures to become a law, because the liquidity management has to happen, and lots of emphasis needs to be provided to that, which we will discuss in the next slide as well. But yeah, something to consider significantly. What if the fund drops in value, which we already discussed, that if the valuation goes down, the earnings will be negative, and you would get to have that negative earnings to claim against the future positive earnings. And whenever that happens, it can happen next year, maybe it wouldn't happen a couple of years, but whenever it happens, you are not losing on that negative earnings, and you can claim back in future years. The next one is, what if the balances increases a lot during the year for any other reason? So we understood three matters: realized gains or realized earnings, unrealized earnings, and the realized expenses. But what if the changes in the member account balance is happening because of other matters, which is not these three matters? So for example, that benefit allocation. So if in a case where two members in a fund, husband and wife, if husband dies, and let's not get into too much detail into that benefit allocation and whatnot, but part of those husband's balance goes to the wife, and now wife has higher member account balance. So in that particular case, the tax liability will be increased too, because the member account balance is higher, so that the higher the earnings, and the proportion of the earnings too. So what sort of information will be required? We haven't got much information on that matter at the moment, so we have to hear more from the government in relation to these matters, because these are the circumstances cannot be controlled or cannot be considered, because no one knows these things can happen. So we don't know. They haven't provided much information on these sort of circumstances, and we have to hear more from government in that regards.
Yeah,
the same thing with
sorry, no, you keep going, Nilay. We've just got something to add a bit later.
Sure. The second thing is the family law splits, the marriage breakdown. The similar circumstances where part of the member account balance from one person goes to another because of the court settlement or the court order. The similar situation where the member account balances increases or reduced because of these matters, and no one knows about that thing happens. So something to look into these things when we will have more clarity about these matters in future. And the third thing is the insurance process. If there is a claim made to the insurance policy and that amount is paid into the super fund, in general, if you have a self-managed super fund and there is a claim made, even though it's in a capital nature, that's not taxable most of the time, which means in general case, super fund is not affected because they're not paying any tax. But in this particular matter, maybe super fund is not affected, but this measure picks up the increase in the valuation of the member balances, and then it will be affected. So we will have to look into this matter as well, that more information will be provided by the government in future about these things. So what we are trying to do here is by putting all these matters and concerns to give you an idea that whether some of those informations, they haven't provided too much information on some of those matters, and then we don't know much because there is no information, and we will have to hear from the government in that regards.
Yeah, maybe just a fourth example of that, just something which we just recently thought about, and it's dealt with this a couple of times, is that if you are a small business and you sell your business and you're able to use a capital gains tax small business concessions, you'll be able to put money in a superannuation pretty much tax free. So that's regardless of what your super balance threshold is. So in terms of planning for this $3 million, it's just something to think about more than anything else, is that if you aren't able to put extra money in a super because you sold your business, that can easily boost up your super balance. But the downside is, if this $3 million measure does come in, will that mean you're going to pay more tax than you otherwise would? Whereas if you didn't put that money in a superannuation from the sale of your business. So that's sort of the type of planning and I suppose modelling that will need to be done as we get more information on this policy, on this legislation, if it does come through. But there is a lot of water to go under the bridge before it does come through. But in terms of planning for the $3 million, and if you are thinking about selling a business and utilising the capital gains tax, small business concessions, looking to put extra money in a super, this is definitely a consideration to that planning.
Sure, thanks, Mark. So having that one covered, let's go to the next slide, which is matters that should be considered. Now, we know that we are not sure whether this will become a law or not. And as Mark mentioned, and we are aware of it, there are so many processes from now up to this becomes a law to be taken upon in order to become law. And even if it becomes law, whether it's the same terms or the same information or the same matters, they may change a little bit. For example, they can increase the threshold, or they can remove the unrealized capital gains or whatnot. So even if this measure becomes the law just like this, or with the variations, we would still have a couple of years from now to then. And what we can consider, thinking about different things that can be done, so that we be ready for that if it becomes a law. Now, please bear in mind, these are some of those matters that can be applicable to one super fund and may not be the others. It depends upon each and every super fund has different balances, different components, different investments, and different goals and objectives as well, which means this is not a standard things that can be applicable to all the funds. But if it's applicable to your fund, if you think, then we can be more helpful on that because in this regards. So let's start with the first one. So it's a member equalization strategy. What it means is, if sometimes we have seen that a husband or a wife, one of the member would have 4 million in his member account balance, and then the remaining partner, the secondary partner, would have only 300,000 or 200,000, and sometimes very less. And there's a significant difference between the member account balances. So if that's the case, then it's something to look upon it, whether if we can swap. There are various strategies that can be utilized to make that happen, and it depends upon whether it's applicable to your particular case as well or not. But if it's possible, then it's worthwhile doing it, because then one member is reducing his or her member account balance by putting into the spouses, and then may not get caught into this measure, or even if they get caught, but they can reduce a proportion of the earnings by reducing the member account balance, if that makes sense. So there are various ways it can be done, by withdrawing by a member account who has met with the condition of release, and then by contributed by the remaining member who has a lesser amount of member account balance, because these days the contributions eligibility is a little bit lenient, and you can make up to 75 years of age as long as you meet some of those conditions, of course. Then those lenient rules may help you to contribute more, and that would help you to implement this member equalization strategy. As I said, it depends on the circumstances, but something to look into, definitely. The second one is the tax effect accounting reporting. Now, what it is in the financials, there is a component where what we can do is we can make a provision for the likely tax implications if the asset to be sold today. So how it works is it creates a kind of deferred tax liability account in the balance sheet, which calculates what would be the tax liability if that asset to be sold today, kind of things, and it applies to all the assets held by the super fund. So because that tax deferred liability will be calculated by our software, and we have to put the right policy and procedures in place, but that can be dealt on, that can be worked upon. But once we calculate that tax deferred liability, then what happens, the net effect of that would be the member account balance would be reduced significantly, because what you are doing is you are creating a liability, like a reserve, which is kind of reducing the member account balance. Now, this kind of strategy works the most for the people who are not in 100% pension. For example, if you have 15% tax liability, whether 100%, either you're in 100% in accumulation mode, or most of your member account balance is in accumulation mode, then this kind of strategy would be quite helpful. Having said that, as I said earlier, it depends upon fund to fund basis, and it's applicable to one fund, may not be applicable to other funds. So we just might need to look into more detail. The third one is the liquidity management. So as we discussed earlier, the cash flow or the liquidity, that management decisions will be really important, because if you have a year where you have excess, like a surplus liquidity, you might need to be having a reserve or having ready for the tax liability that might come 2 years down the track, because you don't know the valuation, and the increase in the valuation may not be under your control, which is a good thing to do. But in these particular regards, you need to have that liquidity so that you can deal with this tax liability. And there are multiple ways it can be done, that liquidity, that it's a general standard. Sometimes some of those funds, they would keep like a 2 years of minimum pension withdrawals as the liquidity management thing. So what they are saying is, in doing that whatever happens in the fund, I'm covered for 2 years of pension withdrawals. So then that gives them peace of mind that they are covered. In this particular matter, because the measures can be more on top of those minimum 2 years of pension, again, this industry standard can be used for 3 years. So if you be ready for the 3 years of minimum pension withdrawals, you are kind of covering yourself from any adverse calculation from the tax liability point of view, or you would have some buffer. The other liquidity management can be considered is, and again, it may not work, but for all, it's just that if you have an excess, and if you have some business requirement, or if you have upscaling house construction costs, funds to be given to kids, that's something to look into it. That's another point of view of looking into it. Or in general, if you are in a particular age and you can make a contributions in the super fund, you utilize that contributions eligibility, making more contributions in super fund, and keep the funds invested until you can utilize that funds as well. So there are various ways you can increase the liquidity in self-managed super fund, so that you be ready for the future tax liability, if any. Something to look into it, something to think about it. Then the thing is the valuation report to be obtained more regularly, as Mark mentioned earlier, which covers that point too. So these are the main, or some of those matters that can be considered in order to be kind of ready if this measure to becomes a law. Those are one of those things, yeah.
Yeah, maybe the other thing that could be considered, Nilay, is look more of a modelling type of thing again, is whether money is pulled out of super to reduce your balance down to under $3 million and invest in alternative structures, whether it's a discretionary trust or a company or personal names if you don't have a lot of income in your personal names or joint names with your spouse. So it's something which should be considered. Whether it's a good idea or not, the modelling for it and the tax benefits will see that. I suppose as a summary, I mean, companies pay tax at 30%, and that's, it's a 30% tax rate in super funds. Is it really any different? The only difference between a self-managed fund and a company at this stage is that you can pull out money out of super tax-free once you're over the age of 60, whereas with a company, you've got to build up retained profits in that company, and the company pays you a dividend so you can use the cash, and then that dividend will be declared as income in your personal tax return. So that's sort of I suppose the thought process that will go around, and whether in terms of whether a restructure is required, whether you pull out money out of super, or whether superannuation is the most tax effective vehicle in the market today.
Definitely, yeah. And again, because different persons would have different circumstances outside self-managed super fund as well, so it varies a lot from person to person. But as you mentioned, you're right, because if that can be invested somewhere else or somewhere else, need to be considered that what's the net tax situation across the whole family. And that's it. The next one, what is next? So now what is happening? The measures has been, upon us, declared by government. So what is next happening? So the government has advised us the next stage is the process will be targeted consultations on implementation of the proposed measure. So they are consulting various bodies and different people, and that will take place between now, which means from 1st of March up to the May 2023 federal budget. So currently it's the consultation process is going on, and then this measure is still a proposal and must be passed into the legislation by Parliament to become the law. So do not rush to move benefits below 3 million, because it's because if it's gone out of the super fund, it's going to be really hard to put it back in, because you need to be considering about the contributions eligibility and cap as well, and it varies from person to person. So it's something to look into it, and shouldn't take the funds out just yet, because no one knows what if this becomes a law, and if it becomes a law, what will be the new measures after the consultation period. So that's a kind of major in all matters discussed about the measures. This is imposed upon us. So the key points are: the self-managed super funds is not affected due to anything in this measure, which means the self-managed super fund is keep going as it's going. The calculation of the tax, so there is no changes whatsoever from the super fund's point of view. It's just that the additional tax will be imposed upon the individual, and then to be looked upon. So just to be mindful of that fact. And then let's quickly have a look of the transfer balance cap, which is the TBC. As we discussed initially, when the start of the webinar, we're talking about that two different terminology: the transfer balance cap, which we are discussing now, and before then it was a total superannuation balance, TSB. The transfer balance cap is the amount that you can keep in your pension, and you cannot have more than that, because the rest of the amount has to remain in accumulation account. They're just trying to restrict the exempt income on the super fund through this measure. So what they're saying is, from 1st of July 2017, that transfer balance caps was 1.6 mil, and then from 1st of July 2021 it increased because it's indexed to 1.7, and because now the inflation's interest rates rises, from 1st of July 2023 the TBC will be increased to 1.9 mil. Now, how it would affect for the different members who have already utilized full, part, or nil TBC, let's discuss in the next slide. So what happens? So then, for example, we are just taking an example of Steve, but so for example, a member hasn't started pension yet, right? So what happens is Stephen has not previously commenced a pension, and his superannuation balance is 2.2 mil. If he commenced a pension earlier, before 1st of July 2023, but after 1st of July 2021, he would have 1.7 million cap. So he could put out of 2.2 million of his balance into 1.7 million in his pension account and remaining in accumulation account to utilize the maximum of this transfer balance cap. But if he would have, that would have been the maximum at that time. But if he wouldn't have commenced a pension, what he can do from 1st of July 2023 to put 1.9 out of 2.2 his member account balance into the pension. So he can utilize that, the higher cap now, if he hasn't utilized before. The second alternative was, or second scenario is, if a person has already used the full TBC. So when it started, utilize 1.6, utilize 100%, put the funds 1.6 in pension and the remaining kept in accumulation account. So at that time, it would have been happened, or 1.6 or 1.7, it utilized the 100% of the transfer balance cap. And because it's utilized the 100% of the transfer balance cap, when this increase of 200,000 of the cap from 1st of July 2021, which is 1.7 to 1.9, that member will not have any benefit of increasing the pension account balance, because how it works is, when you utilize a transfer balance cap, it works on the proportionate basis. So if you transferred 1.7 or 1.6 when it was the current transfer balance cap at that time, and if you utilize 100%, now you don't have any room to increase your pension account by. So that's the kind of, that is how this transfer balance cap works. And it will be more understandable when I'll give you the third example, which is if the Stephen previously commenced a pension, so half or whatever different proportion. So in this particular case, after 1st of July 21, if Stephen has commenced a pension of 1.275, which is a 75% of 1.7 million cap at that time. So he utilized 75% of his cap at that time to commence a pension. Now what happens? After 1st of July 2023, he can utilize the remaining 25% of the original pension, which is 475,000, so 425,000, which is 25% of 1.7 million at that time, plus 50,000, which is the remaining unused transfer balance cap of 25% can be used to increase his pension account. So in a nutshell, a member can only utilize a proportion of the increase in the transfer balance cap to increase a pension. It's a little bit of complex matter. And if you are into that situation, please contact us so that we can help you out more. But this is just to put the information there so that you understand how it works. So that's from me, Mark.
Yep, no worries. Thank you, Nilay, for your very informative presentation. As was mentioned in there, is like really the policy at the moment is to really do not a lot with your super funds. There's nothing really to do because there's very limited information out. Obviously, there's no legislation out. There's a lot of water to go under the bridge. The first one is that the Labor government must be re-elected for this to go through. The Libs have said they will just eliminate this policy and not go ahead with it. So the first step is Labor must get re-elected, must have the balance of power in the Senate. There'll be a parliamentary debate if all that happens to fine-tune the policy, and we'll go through all the professional bodies to, I suppose, refine it and voice their concerns before we got any type of, I suppose, consensus about how this is all going to look like. But if it does go through, a point to note is that this will affect tax returns and super funds for the year ending 30 June 2026. Generally, payment on those funds based on current lodgement dates will be the 15th of May 2027, which is basically just over 4 years away. So there is still a lot of time to go through the strategies and everything else if this is ever implemented. So just something to take into consideration. The next big night is obviously a budget night, the 9th of May 2023. that's always a fun night for accountants. It's like our New Year's Eve, so to speak. So and I suppose word from the street, so to speak, is that the budget may focus on small business in terms of taxes on that. Obviously, there is a push to, I suppose, bring the budget sort of reduce the deficit down a fair bit. Two measures which are already enacted is that, which you may not be aware of, is that up to 30 June 2023, you can write off 100% of any assets that have been purchased for business, but that expires on 30 June 23, where the threshold has been unlimited. That the new threshold from 1 July 23 will be $1,000. So any assets that you buy up to $1,000 can be written off based on the legislation that will be reenacted again on 1 July 23. So something to consider. And the other one, which hasn't really got a lot of press, is what they call the low to middle income tax offset, which really affects individual taxpayers. I think that's a total rebate that comes off your tax up to incomes of $126,000 of about $1,150. That will not be there for this year, for 2023. So people who receive refunds, reduced tax liabilities based on that offset, that will not exist for this current year. So there are two measures that are already starting to bring back some money to the government. Let's see what the budget will provide for us in a couple of weeks' time. So thank you everybody for your attendance. Hope you got a lot out of it. Thank you, Nilay, for the presentation. It was excellent, and hope to see you all soon. Thank you.
Thanks all. See ya.